Joining us for a further look and what's playing itself out on that market scene is Wessel Joubert from Oyster Catcher Investments. Wessel, always a pleasure and a good afternoon to you.
Hi, Norley. Thanks for having me.
Wonderful. Wessel, let's speak about maybe what we're seeing in markets today. We are seeing mostly green screens, but yesterday markets closed off in the red, I think. It wasn't a decent day. I'm keen to get your thoughts on what's been driving this on and off again performance.
It feels like every single time you guys get me on, it's this exact same reason, just the different movements up or down. It's been all around interest rate expectations, and I think that has been roughly the driver for these smaller up and down moves for the majority of the year so far. So what we had last night were a couple of comments from the Fed, from the ECB, all stating that interest rates are most likely going to be a little bit higher and monetary policy a little bit more restrictive for a little bit longer than expected. And I think that always kind of gives the market a little bit of jitters. It's the easiest frequent data points for the market to trade on. So when they don't expect interest rates to go down as soon as possible or as soon as they expected, you'll see equities kind of underperform. Everybody's kind of waiting for the market or for the Fed to pivot to tell them, listen, the interest rates are probably going to be down from here on out for the next, say, year or so. And then you'll see this massive rally in equities. But until we get clear indication, the Fed's going to hold tight until they see inflation under control before they give the market any, I suppose, positive signals.
I'd like us to stay in the United States. We saw NVIDIA out with a set of numbers, shooting the lights out. But I've read some analysts saying that this is just not sustainable. I'm keen to get your thoughts here, Wessel. Or have we created a bit of an NVIDIA bubble there?
Yeah. So the whole NVIDIA investment case prior to this was driven by mining for Bitcoin. You had the whole blockchain and you needed GPUs. They can process quite a lot of algorithms at a single time. So NVIDIA produced these and it provided I suppose, a very good base for everything to grow off. Everybody then thought, well, it's a little bit of a bubble because this trend isn't going to last forever. And then we had the announcement from ChatGPT launched kind of end of last year, and everybody realized, well, maybe we might need these ChatGPT uses what they call large language models, which also uses quite a lot of processing power, simultaneous processing, that the GPUs are then very good for, and other chipsets that they use are very good for. And then all of a sudden, the sales expectations went from, I can't remember the exact numbers, but it increased by multiples. And those sales have actually realized. Often what we find with these companies is that the estimates or the expectations just run very, very far ahead of what is possible or reality. From here, the sales are more likely to moderate a little bit. And the main reason for that is the chip ban on Chinese imports. China is a little bit behind the rest of the world in terms of the AI race, I want to call it that. So the previous expectation was quite a lot of investment will come from China, but with China being banned from importing certain chips from NVIDIA, that kind of demand factor isn't there. Although the rest of the world will still continue to grow and have high demand for these chips, we might see it slow down a little bit. If I remember correctly, the ban came in beginning of this year. So your last quarter in NVIDIA's financials or early next year, you will have a very high base to contend with. But the sales are very strong, and if you see all the applications and potential cost savings for companies coming from AI, there might be quite a long runway for NVIDIA to make good money. The growth rates might not be as stellar as they have been in the past, but they might still be very strong.
It's very interesting one there, Wessel. Let's talk about ARK. They're keen on a rights offer there. I'm wondering what investors might be thinking about this one. In the past, we've had conversations, I think, with various analysts about the true value of the assets within ARK. And I'm wondering now that they're speaking about a rights offer, how investors might be trying to digest this one.
It always depends on exactly what the funds for the rights offer are going to be used for. As you mentioned, valuation or valuation on the current assets that they have is very, very important. But it really depends on what the money is going for. Usually, if a rights offer is done at a reasonable price, so a slight discount to the current share price, the current share price hopefully reflects the actual values of the underlying assets, right? And if that rights offer is then done to either grow one of the assets further, so further investment into a good growing asset, you might have a short-term weakness in the share price, but over the long term, it's positive for the share. When the rights offers are done to fund businesses that the market doesn't think is going to grow into the future, or effectively funding a bad business, and they call it throwing good money after bad, the share price usually has a bit of an overreaction to it. In our case, we can hope it goes towards growing the portfolio a little bit more, raising money for new investments.
Very interesting one as well. Let's talk about Rhodes Food Group. FMCG has had a bit of a tricky time. I think haven't been able to escape the issues that we are seeing in terms of the macros in South Africa. But I think RFG has actually done reasonably well amidst the circumstances. What I'm not sure about, Wessel, is if they can sustain this, considering what they are saying about what's happening at our ports.
Yeah, well, from their commentary, it seems like they think they can sustain it and even improve on it a little bit from here, especially on the margin side. We did see volumes were very, very weak, and that wasn't only in South Africa, that was on the international business as well. So you do see consumer being weak in a couple of different geographies. That was luckily offset by price increases. So the high food inflation helped a little bit. When all your peers are raising prices, it's easy for you to also raise prices. But what we have to remember is that they weren't able to pass through all the price increases of their raw material costs last year or in the prior period. That is now somewhat reversed. Your input costs didn't go up as much, but you were still recovering some of the cost increases from last year, just kind of leveling out that price increase. Then there was a little bit of an acquisition that helped, a little bit of FX gains that they had in the business as well. But overall, quite a strong set of results.
Very interesting one as well. Wessel, I'm keen to get your stock pick, but before we do that, let's reflect on counters that have found favor with your industry peers.
Thermo Fisher Scientific, it's a life sciences company. It makes everything from, it makes all the tools and bells and whistles to make science happen, and for all those smart pharmacy people to develop vaccines and all of the smart things that they do. So anything from just test tubes to electronic pipettes to mass spectrometers to all of those fancy gizmos and gadgets. Gene sequencing machines and all of those things that actually help science to
using Foschini Group. They have reported, even though their earnings were somewhat disappointing, I think the prospects are looking quite good. They've held a series of investor engagements. We're seeing a lot of investor interest. They're very much a forward-thinking retailer, omni-channel, and have a very big exposure in the South African market, but also in the UK and Australia, and at a reasonable price here, and I think prospects look good. So, yeah, we like it for the medium term.
It's Ethos Capital Partners. It's an investment holding company. They announced roughly 2 weeks ago they probably won't look to make new investments. They look to realize their current investments. It is trading at a significant discount to its own intrinsic value, and this management team will not dilute shareholders by doing a rights issue at these low prices as some other investment holding companies have done. They will look to realize the value, so that unlocks the first discount, but they also have a significant stake in Brait, another investment holding company that's also trading at a significant discount and is also looking to unlock the discount through distributing their Premier Food shares, which is the Premier Group, which is listed on the JSE, and then they have Virgin Active as well as a significant investment. So between the discount being unlocked at Brait and the discount being unlocked at Ethos, I see significant upside and a management team that's going to actively look to unlock this discount, double discount, in the short term.
All right, Wessel, keen to get your thoughts on some of those counters. We have Thermo Fisher Scientific, TFG, as well as Ethos Capital Partners.
Yeah, so I mean, I'll go with the one we like the most, Foschini Group. We do think that over the past couple of years, they've been very acquisitive, and the market was a little bit disappointed with never getting additional operating efficiencies out of their acquisitions. We have seen a lot more constraint from management side recently. The margins are about 600 basis points below where they were prior to COVID, and with a couple of key reasons for that. They are doing distribution centralization and consolidation, as well as they've got Bash, which is running at a bit of an operating profit loss still. And those are under their control. And those alone can halve that 600 basis point margin gap that they have. Just improving margins without having any top line growth is very, very attractive at this stage. And then we do think as the economy recovers, there's a couple of extra things that they can do to get back to hopefully close to pre-COVID margins. So a lot of self-help in Foschini Group at this stage. And we do think the market has unnecessarily kind of punished the share price for where it is now. So we do have quite a favorable outlook on that.
And which counter are you going with this afternoon?
Okay. Today we're going to pick Process, just because it has such good results last week. I'm kidding. I've been picking Process for a while now, and it goes up and down. But the big benefit there is we do think Tencent is a very good asset, and the results out of Tencent looked a little bit muted when you just look at it on paper. Revenue growth not that strong, but margin expansion and bottom line phenomenal. The big thing is, I think what the market isn't appreciating is how they're accounting for a lot of the new growth businesses. They're not accounting for it on a normal revenue basis. They're accounting for it on a net basis, which means the new business is much, much higher profit when it gets booked into the revenue line. And that, I think, is underappreciated by the market. Revenue growth will be a lot higher if it was accounted for differently. And for that reason, we think over time, hopefully the market realizes this.
Well, Wessel, it's always a pleasure speaking to you. Thank you so much for your time and insights this afternoon. That was your Midday Markets Update with Wessel Joubert from Oyster Catcher Investments.